Today, ICICI Bank is a towering force in global finance. It is a $6 billion titan operating over 7,000 branches across India. Millions of everyday consumers interact with it through intuitive smartphone apps to pay bills, take out home loans, and manage their life savings. But if you trace the origins of this retail behemoth, you hit a strange paradox. For its first 40 years of existence, ICICI did not have a single everyday customer, absolutely no branches, zero everyday depositors, no checking accounts. The government of India and the World Bank founded the institution in 1955. Newly independent India needed heavy industry, and heavy industry needed capital. ICICI was built to be a development finance institution. It operated strictly as a state-sanctioned pipeline, borrowing money from international lenders and injecting it directly into massive textile, chemical, and manufacturing projects. Commercial retail competition wasn't even an afterthought. The institution simply wasn't built to do it. That isolated existence lasted until 1991, when India dismantled decades of licensing controls and swung open its economy to private capital. Suddenly, standard commercial banks were allowed to fund those exact same corporate projects. Traditional banks draw from massive pools of cheap retail deposits, but ICICI relied on expensive international debt. Without cheap deposits, ICICI's cost of capital remained high. Liberated commercial banks offered borrowers lower rates, completely undercutting ICICI's model. Deprived of its historical monopoly, ICICI faced an existential funding crisis. To survive, it had to acquire cheap retail deposits, which meant abandoning its identity as a pure development lender and building a commercial bank from the ground up. Indian regulators actively encouraged development lenders to become universal, deposit-taking banks. So, in 1994, the enormous ICICI parent company created a tiny commercial banking subsidiary in Gujarat, strictly to secure a retail license. They operated side by side until 2002, when ICICI executed a highly unusual legal maneuver. Instead of the parent absorbing the child, they reversed the flow. The massive development finance parent merged itself into its own younger, much smaller banking subsidiary. This structural hack created an instant universal bank. ICICI effectively bolted its massive wholesale-funded corporate lending sheet onto a legally valid retail banking license. The reverse merger solved their legal and funding constraints on paper, but practically they still faced an enormous hurdle, actually convincing millions of retail customers to hand over their deposits. At the time, Indian banking was overwhelmingly focused on corporate lending. The incumbent public sector banks already dominated those relationships, and ICICI CEO KV Kamath realized that trying to beat them at their own game was a losing strategy. Instead, he directed the bank's focus toward an entirely different demographic, the massive, underbanked, and rapidly emerging Indian middle class. Consumer credit and retail deposits offered a far larger, untapped growth opportunity. Building thousands of physical branches across the country to reach those people would take decades, so ICICI bypassed the real estate problem entirely. In 1998, a time when personal computer and internet penetration in India was virtually non-existent, they launched internet banking. Treating technology as a direct substitute for physical branches gave ICICI a massive head start. They captured a huge share of the expanding consumer credit market before the traditional public sector banks could fully adjust. This retail machine grew rapidly, eventually coming under the leadership of Chanda Kochhar in 2009. She helped build the retail division from the ground up, but her tenure as CEO exposed a severe breakdown in the institution's internal governance. In 2012, an ICICI-led banking consortium approved a loan worth roughly $480 million to the Videocon Group. This chart tracks the flow of those funds. After the loan was approved, Videocon's chairman directed investment funds into a renewable energy company co-owned by Deepak Kochhar, Chanda Kochhar's husband. A large portion of the initial Videocon loan later turned non-performing. When whistleblower complaints surfaced in 2016, the ICICI board initially dismissed the allegations as unfounded. But as public and regulatory scrutiny intensified, an independent inquiry found violations of the bank's code of conduct regarding adequate disclosure. Kochhar was terminated, and India's Central Bureau of Investigation eventually arrested both her and her husband. The episode revealed the dangers of a star CEO culture. A failure of basic board oversight nearly destroyed decades of built-up institutional trust. In mid-2018, with the bank's reputation severely damaged, veteran executive Sandeep Bakhshi took over. His immediate mandate was to rebuild regulatory and investor confidence. Bakhshi implemented a strategy he called risk-calibrated profitable growth. He explicitly moved the bank away from the kind of concentrated, relationship-driven corporate lending that had caused the Videocon scandal. Prioritizing asset quality drove the net non-performing asset ratio down to a stable 0.4% by the mid-2020s. They achieved this safety by launching a second wave of digital platforms, breaking the loan book into millions of smaller, granular, digitally processed transactions. Saving the bank required management to prioritize systemic risk controls over aggressive relationship lending, ensuring no single sector or borrower could easily threaten the balance sheet again. ICICI breaks the traditional corporate pattern. Most companies fall into decline because of rigid adherence to their founding business models when the market changes. ICICI survived because it was willing to repeatedly destroy its own identity. When its funding model failed, it became a bank. When corporate lending stalled, it bet heavily on retail. When its governance failed, it investigated itself, replaced its leadership, and tightened its lending standards. That institutional plasticity has resulted in consistent market validation. Today, ICICI stands out as an indispensable pillar of Indian finance, generating billions in profit while continually expanding its multi-line financial services footprint. It grew to this massive scale because it didn't stay tied to what the government wanted in 1955. It continually adapted to become exactly what the consumer needed today.